Alright, in this video, we're going to talk about two books, the journal and the ledger. In order to do that, we're going to use an example of Gamgee's Potatoes. Now, if you're not familiar with Samwise Gamgee, he's a character from The Lord of the Rings. And if you haven't read The Lord of the Rings, or watched The Lord of the Rings, or played Lord of the Rings Trivial Pursuit, I highly encourage you to do so. But this is the handout we're going to go through. Now, I put these handouts together so that we could have something to base our discussion on. The handout walks us through 4 different things. We're going to talk about the 2 books. We're going to talk about the key questions. We're going to talk about the classified balance sheet. And we're going to talk about financial statement ratios. In accounting, businesses use primarily 2 books to keep track of changes in the elements of the accounting equation. And as we said last time, the accounting equation is assets equals liabilities plus equity. Now, these 2 books that are used to be actual books, physical books. And that's why we refer to company financial records, even to this day, as the books. Now, the journal is used for recording daily activity. This is where we would have recorded what happened during the day. Things that were given, things that were received. Then, at the end of the period, we would take that information and move it over into the ledger, which is used for keeping the balances in all of our elements, all of our accounts. So, the journal records the transactions within the business and between business and others. The ledger keeps track of what is owned and owed, what has been earned, and what has been incurred. A journal that we're going to use for our purposes is very simple. We have a column for the date, a column for our account, and a debit and a credit column. We'll talk about this in a second. The ledger, again, that we're going to use is fairly simple. Each account, each element that's in our ledger has to have a place to show increases and decreases. So we have to have a column for debits and credits, and we have to know what increases and what decreases that account. So let's take a look again at the accounting equation. The accounting equation, assets, liabilities, and equity. Now, I like to abbreviate that with an A, an L, and an SE for stockholders' equity. So we have assets, liabilities, plus stockholders' equity. If I'm going to keep track of changes in this equation, I need to have a way to keep track of increases and decreases in each of these elements. And so we use what are called T accounts. Now, we call them T accounts because they look like T's. Now, a long time ago, in the late 1200s and early 1300s, some Italian merchants came up with this system to keep track of increases and decreases in this equation in a way that would ensure that it's always in balance. That system is the system that we still use to this day. And that system is called double entry accounting. Now, I don't have time to go through all the history in this video, but if you're interested, there's a pretty good book that I recommend. It's a book called Double Entry. Now, it's written by Jane Gleason White, and it goes through the history of how we got our modern day accounting system. A lot of talk about mathematicians, Some talk about Leonardo da Vinci, and some talk about artwork. Really interesting read if you're interested in that kind of stuff. Now, their system went something like this. The left side of every account is called the debit side. The right side of every account is called the credit side. The debit side, the credit side. Now, one thing to note, it's interesting. The abbreviation for debit is DR. Obviously, that's not, there is no R in the word debit, but this is the abbreviation carried over from the Italians who would have written in Italian. And so, we're looking at this debit and credit, and we see that each account, no matter what it is, has the same setup. Debit's left, credit's right. What's different is what it does for the account. For assets, if you debit it, it makes it go up. And if you credit it, it makes it go down. Liabilities are the opposite. If you debit a liability, it goes down, and if you credit it, it goes up. Equity follows those same rules. Debit, credit. So, if you look at it this way, if you're on the left side of the equation, your balance and increases is going to be on the left side. If you're on the right side of the equation, your balance and increases is going to be on the right side. And that's what we call the normal balance. So the normal balance for each of these accounts is on the side where we would put increases. So the key to this is making sure we understand when something happens, what do we do? So the next page here talks about the key questions. The key questions when recording stuff in our journal. The first thing we have to know is what accounts are affected. The second thing we need to know is that account going up or down because of what happens? And then the third thing we have to understand is, does that mean we debit or credit that account? These three questions are huge. Huge. Listen to the professor. These are huge. Okay? You've got to know how to do this in order to record journal entries. So take your time, think through these things as you do them. Now, we're going to start with Gamgee's potatoes here in the list of accounts with beginning balances as of the beginning of August. They had $8,000 of cash, $2,500 of supplies, and so on. Now, we could build the equation with this information, right? What do we have? We have assets, cash, supplies, land, buildings, equipment. We have liabilities, accounts payable, notes payable. And we have stockholders' equity, common stock and retained earnings. And so we have their equation. We could build it to start with. But what we're interested in here is what happens during the month of August. And so we have 4 things that happen during the month of August. These 4 things that happen, these 4 transactions, are going to change this equation for the company. And so we need to record these 4 things and figure out what's going to happen. So, what I have for you in the next handout here is a journal. The journal is fairly basic. It has 4 columns. We have a column for the date, column for the account names, and a debit and a credit column. And so we're going to put back here our equation. Let's try to do it this way. We can make sure we fit this here. That should work. We have 4 things that happen. In letter A, Gamgee's Potatoes issued 1,000 shares of common stock for $100,000. So what's actually happening here? Gamgees is giving shares of ownership to people, and those people who are now becoming investors, owners, are giving Gamgees $100,000. So what accounts are affected? Well, if I'm receiving cash from people, my cash is affected. If I'm getting cash from people, is my cash going up or down? It's going up. And if my cash goes up, is that a debit or a credit? Well, if we look at assets here, to show an increase in an asset like cash, we would debit it. So to start our journal with letter A, we are going to put down the cash account, and we are going to debit it for $100,000. The next thing, what else is happening? If all I do is change my assets, my equation no longer balances. So what's happening to the amount my owners have invested in the business? Well, it's going up as well. And so I'm going to see an increase in what account? Well, what account represents the amount owners have invested? Well, that is common stock. And common stock as an equity account is going to increase with a credit. So here's my journal entry. I have a debit to cash for $100,000 and a credit to common stock for $100,000. Now, what do you notice about this journal entry? Well, the debit comes first and the credit is indented. Now, why do we do this? We do this so that it's easier to read the journal. If I line everything up here on the left-hand side, then I have to look over here to see whether it's debited or credited. But if I indent credit accounts that are credited here, and I don't indent the debit accounts, then I can read this without even looking at the numbers. So it's a formatting thing. Not a huge deal, but it's something that we do. The second thing that happens, letter B, we borrowed $15,000 from a local bank, payable in 2 years. If I borrow money from a local bank, what am I getting? Well, I am getting cash. My cash then is going up. How do I show an increase in my cash? Assets are shown increases with a debit. So I'm going to debit cash for $15,000. If again, that's all I do, my equation is out of balance. And so what else changes? Well, I got more cash, but I owe more money now. My liabilities are going to go up. Which liability represents money I borrow from people that I have to pay back with interest? That is going to be notes payable. So I'm going to credit notes payable for $15,000. That's my journal entry. Now you notice something about the journal entries here. Every journal entry has to have the same amount of debits as it has credits. If every journal entry has the same debits as it does credits, then your equation is balanced. And so we move on to C. C gets a little bit trickier. We bought equipment for $70,500. We paid $10,500 in cash, and we signed a note for the rest. So what happens here? What accounts are affected? Well, the equipment account is affected, right? What happens to my equipment account if I purchased more equipment? My asset for equipment should go up. So I'm going to debit equipment for $70,500. That is what it cost. And as we talked about in the previous video, assets are recorded at cost. The second thing that's affected is my cash. I paid $10,500 in cash. My cash, which is an asset, is going down. So what do? I credit cash for $10,500. The rest I owe. I signed a note. I have to pay it back with interest, most likely. And so what do I see an increase in? I see an increase in the amount I owe other people in the form of notes payable, $60,000. Now, why do I know it's $60,000? Well, for one, the total cost is $70,500. I paid off $10,500. I'm left with $60,000. But I also know that credits have to equal debits, right? Lastly, I bought supplies on account. On account. $4,000. Purchasing supplies on account means I have not paid for them yet. But what did I receive? I received some supplies. So my supplies, my asset is going up. And so I'm going to debit supplies for $4,000. And the amount I owe other people, liabilities, right, is going up. My accounts payable. As we talked about before, accounts payable represents the amount you owe for goods and services you have purchased. So this is how we do journal entries. Businesses engage in transactions. They have to record those transactions. They have to account for what happens. That is done in this first book, what's sometimes called the Book of Original Entry. And so, journal records activity. But what doesn't this journal tell me? This journal does not tell me how much cash I have. It does not tell me how much I have in total supplies. It does not tell me how much I owe people for notes in total. All it tells me is what happened during this period. So, we have to go through the second process. We have to take what is in the journal and move it to the ledger. This process is called posting. So let's do that. So here's the ledger that we're going to use. This is the fourth sheet of paper. And the journal feeds into the ledger. But the first thing we have to do in this case is fill out the ledger as it was when we started this period. So we have a list over here of accounts and their beginning balances as of the beginning of the month. And so for each one of those, I'm going to create an account. So we have a cash account. We have a supplies account. We have a land account. Buildings. We have equipment. We have accounts payable, or AP. We have a notes payable account. We have a common stock account. And we have a retained earnings account. Fairly simple for this company in this example. What do we do next? Well, we know these accounts, when we started this month of August, had these values in them. They were the beginning balances. But the question becomes, when I move those beginning balances into my accounts, what side does it go on? Well, as we said, there are normal balances for these types of accounts. So for cash, the beginning balance of $8,000 would be a debit balance. For supplies, same thing. For land, and buildings, and equipment. These are all assets, and so we have debit balances. The liabilities, accounts payable, and the equity accounts have credit balances as the normal balance. So the beginning balance for AP of $2,000 would be on the right side. The beginning balance for notes payable of $8,500 would be on the credit side. For common stock, the beginning balance is on the credit side. And the same for retained earnings. So we start by filling out our accounts. Now, Once we have the beginning balances in each account, then we can go through the posting process. The posting process is fairly simple, but you have to pay attention and be careful, particularly when doing this by hand. Now, we don't do this by hand anymore. Many of these steps are done with software and computers. But I tell my students all the time that if you do not know how it is supposed to work on a piece of paper, you will not understand what a computer software system is doing. So it's important that we learn how to do this on a piece of paper. And so what do? Well, the first journal entry has a debit to cash of $100,000. And so we're going to move that letter A into the cash account. And then it's good practice to check it off. That way you don't forget or you don't skip one. Then the credit was to common stock. So we're going to credit common stock for $100,000. And we can check that one off. Letter B, cash, $15,000. Credit is to notes payable. Letter B, $15,000. And we can check those off. Letter C, we have a debit of $70,500 to the equipment account. We have a credit in letter C of $10,500 to the cash account. And we have a credit, letter C, of $60,000 to the note payable account. So we can check those off. And lastly, with letter D, we have a debit to supplies of $4 and a credit to accounts payable of $4. Now, you'll notice that in this period of August, we didn't use every account. We didn't post something into every account, and that's okay. We're only going to be posting things into the account that we are actually using. So, what do we do from here? Well, once we know that we've posted all of our activity, then we can find the balances in each one of these accounts. In the cash account, we're going to add up all the debits and subtract the credits, and we find that we have $112,500 in the account. Supplies, add up the debits, subtract the credits, we've got $6,500. Land didn't change. Neither did buildings. Equipment started with 9. We added in an extra $70,500. So we should have $79,500. AP started with 2. Added 4. So we should have 6. Notes payable started with $8,500. Then we added $15,000 and we added $60,000. So we should have $83,500. Common stock started with $154,000. We added another $100,000. So we should have $254,000. Retained earnings didn't change. So that's the posting process, right? Where we go from the journal to the ledger. And we can find the balances, right? Used for keeping balances. The ledger then allows us to do what we want to do next. Once you have a ledger, then we can go to the next step, which is to build what's called a trial balance. A trial balance simply is a test. Okay? So you can think of it as a test. We want to know, is our equation balanced? And so we look at the balances in our accounts here, in the T accounts in our ledger, and we move them over into a trial balance. Now, a trial balance is listed in a particular order. We list our accounts in financial statement order. Financial statement order. So the balance sheet accounts come first. On a balance sheet, assets come first. So we have assets. We have cash, supplies, land, building, and equipment. These all have debit balances. So we move the balance, for example, 112.5 in cash, over to our trial balance. Then we move on to liabilities and equity. Assets, liabilities, stockholders' equity. The trial balance then tells us if our debits and our credits equal. If they do, then we know our equation is balanced. This does not tell us if our equation is correct. It only tells us that our equation is balanced. But the trial balance is a good step because it helps us understand, is our equation balanced or not? If these two numbers do not equal, we have a problem, and we need to go back and start looking for it. Once we have a trial balance, then we can build our balance sheet. Now, we're going to adjust our balance sheet a little bit in this video. We are going to build what is called a classified balance sheet. The classified balance sheet organizes assets and liabilities into current and long-term categories. The difference between the current and long-term categories is a 1-year timeline. One year. So, current liabilities, current assets. These are assets that will be used up or turned into cash within 1 year, before 1 year. Long-term assets are assets that will not be used up or turned into cash within the next year. Current liabilities are those that we are going to have to pay off within the next year. Long-term liabilities are those that we are not going to have to pay off within the next year. So this is not an exhaustive list of these, but for what we've looked at so far, this is kind of how it shakes out. Our current assets are going to be cash, accounts receivable, and supplies. Liabilities, accounts payable, and potentially notes payable, if it's due within the next year. Long-term assets are land, buildings, and equipment, typically not going to be turned into cash or used up within the next year. And long-term liabilities, we have notes payable. So when we go to build a classified balance sheet, it's going to look a little different than the one we built in the previous video. Here is our classified balance sheet. As we see, it starts with the name of the company, balance sheet, name of the statement, and the date. The balance sheet is for a particular period in time, a particular date. So August 31st, we're going to put 2025 here. We have assets listed on the left-hand side, liabilities and equity on the right. I'll show you another way to do this in a second. But as you'll see, we have current assets. Current assets are cash and supplies for our company. Then we have land, building, and equipment, which are non-current. The total assets, $343.5. Then we have liabilities, which starts with current liabilities. The only current liability we have in our example is accounts payable. The notes payable is a long-term liability. And then we have total liabilities. Common stock, retained earnings, those are our two equity accounts. Total stockholders' equity, and total liabilities and stockholders' equity. So here, right, our total is the total of this and this, right? The total liabilities and total stockholders' equity. So this is a classified balance sheet. It means that assets and liabilities are classified into current and long-term categories. Now, why do we do this? Well, we're going to look at that in a second. The other way you can build a balance sheet is like this. Instead of having assets and liabilities on opposite sides and the totals down here matching each other, you can build it vertically. So this is called a report form balance sheet. This is called an account form balance sheet. But the report form balance sheet is essentially the same. It's just organized as assets, liabilities, and equity. Here we have assets, liabilities, and stockholders' equity. Almost every company is going to use this kind because paper is longer, right, than it is wide. So, but when we look at these two things here, we have a trial balance and a balance sheet. Students often get this mixed up. They often get this mixed up. So let's look at some of the differences. First of all, the trial balance is not a financial statement. It's not a financial statement. And the reason that it's not a financial statement is that it's not given out to anyone outside the company. In addition, financial statements like the balance sheet you see here are missing something that we have on the trial balance. What do you see here? Debits and credits, right? Debits and credits on the trial balance. We never have debits and credits on financial statements because you do not need to understand debits and credits to read financial statements. As long as you understand the language, you can read these statements. But the trial balance is not a financial statement. In addition, trial balances will have every account the company has. The balance sheet only has assets, liabilities, and equity, right? We don't have any revenues or expenses yet for this company, but eventually they will get added to our trial balance. They will not come over here on the balance sheet though, right? Assets, liabilities, and equity. Our revenues and expenses will be on our income statement. Now, to answer the last question, what do? We take our balance sheet and we do some ratios to try to interpret what's going on. So we have the current ratio. The current ratio takes current assets and divides it by current liabilities. If we look at the current ratio and we take 119,000 and we divide it by 6,000, we get 19.8 roughly. What does this mean? Well, this means that for every dollar that we owe within the next year, we have $19.80 some cents with which we can pay it off with. So if we have $19.83 for every dollar in current liabilities, do you think we'll be able to pay this off? Well, it looks like it at this point, right? So the current ratio, at minimum, right, that you would want to have would be 1.0, where my current assets, those assets which I think will turn into cash within the next year, and the current liabilities, what I think I'm going to have to pay off within the next year, the minimum I would want to see is 1, which would mean they would be equal. So we look at a business's solvency by looking at this ratio here. Now, the other one we have on our sheet is the debt to equity ratio, where we take total liabilities and we divide it by total stockholders' equity. That didn't come out so well. Total stockholders' equity. Okay. So what does that do for us here? Well, total liabilities, 89.5. Total stockholders' equity, 254. What do we get? we get 0.3524 if we round it here. What does this tell us? Well, this tells me that for every dollar that owners have invested in the business owes 35 cents. So, who has a greater claim to the assets of the business? We have total assets of $343.5. Who has the greater claim? Well, for every dollar owners have invested, the company owes only 35 cents. We see the owners have invested $254,000, but the company only owes $89.5. So the owners have a greater claim. So if the debt to equity ratio is less than 1, then the owners have the greatest interest. If the debt to equity is greater than 1, then creditors have the greatest interest. And which one do you want to have as an owner? Which one do you want to see? Well, you'd like to see yourself have the greatest interest. So we would like to see this lower, if possible, right? So financial statement ratios are important. Now we can use these numbers to compare our progress, Gamgee's potatoes. We can compare Gamgee's progress over time using these ratios and calculating them each month to see how they're doing. We can also use these ratios and compare them to their competitors' ratios if that information is available to us. And then we can use them to compare. The nice thing about financial statement ratios is that it removes the total dollar effect, the total dollar amounts, okay, by converting it into a ratio. Some ratios are percentages, some are listed as decimals, but it removes total dollar figures so we can compare them on a more equitable basis. This encapsulates the process we go through in doing accounting. We go from the journal, where we record activity that happens. We move that activity into the ledger so we can figure out what the balances are in our accounts. We take these balances and we prepare a trial balance to see if our equation is balanced. And then from our trial balance, we can then build our financial statements that we can give to people. So these are the first few steps in the accounting process. And we're going to learn more about the process and more about the statements as we move forward.